Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning, everyone. Hope everyone had a nice weekend. A lot to talk about, obviously, with the movements in the financial markets. Certainly talk about the concerns regarding the coronavirus, and also speak about some of the other factors that might be influencing the market, although not as obvious as the coronavirus this morning. So we are at one of those moments, in my opinion, where the returns that an investor or the client of an advisor will receive over the next few years is somewhat influenced significantly by some of the decisions that are made in these volatile times like we are experiencing presently. So the decisions that we guide our clients to, or if you're an investor that you choose to make it these volatile times, certainly will have a very meaningful impact on your portfolio. So it is a time to assess, think clearly, try and put everything into perspective, try and be realistic. There are certainly unknowns, and all the brilliant thinking in the world can sometimes not lead to what in hindsight looks like a good decision. But the probability is, if you keep a clear mind, that if you assess the facts, that you will make good decisions, and those good decisions will be rewarded. In this environment, if you're an advisor or if you're a client, the number 1, 2, or 3 things to do are to communicate. Speak with clients. Clients speak with advisors or speak with trusted confidence in order to fine-tune and hone your thinking. It's critically important that advisors reach out to each and every customer, let them know that they're thinking about them, discuss the current market environment with them, and go over their entire portfolio, and if something seems amiss, then make adjustments. In most cases, client portfolios should be set up so that they can withstand this volatility. Volatility like this, while jarring, is not unanticipated. We've seen this before. We've seen this as recently as the end of 2018, not as quickly, but over several weeks instead of several days. We've seen this in the financial crisis. We've seen this in the early 2000s, the late 1999s, and therefore we have the benefit of experience. So taking a look at financial markets, right now markets have been super volatile. If you're looking at futures, last night they were up a few hundred points. This morning they were down a few hundred points. And right now they are trading slightly to the negative, at least if I'm looking at the most recent information. So you can expect one thing, and that is continued volatility. And most important is not to try and necessarily have answers, but to be a sounding board and resource for clear thinking and strategizing. Put things into perspective. Last week, the S&P down 11.5%. Year to date, the S&P is down about 8%. Over 1 year, the S&P is up 8%. Compare that to the Dow, which was down about the same amount, was down about 12% last week. The Dow was down 10% for the year, but if you're looking year over year on the Dow, it's up just 0.4%. The NASDAQ, if you're looking at that, year to date is down about 4.5%, but over the last year, the NASDAQ is up 15%, so quite a dispersion still between the NASDAQ, the S&P, and the Dow. Now, looking at Treasury yields, we are seeing Treasuries, the 10-year Treasury specifically, was up almost 3% last week. Year to date, the Treasury was up over 7%, and the 1-year Treasury, the 10-year Treasury over 1 year was up over 16% on an annualized return. So Treasury's continuing to rally, and we'll talk a little bit about that, whether or not bonds, make the same amount of sense as they did in previous market sell-offs. And Brad may add some information and some insight on that as well when he speaks. So speaking about some news flow this morning. Outside of the coronavirus, President Trump was tweeting about the coronavirus this morning, saying he was meeting with pharmaceutical companies about working on a vaccine. But in other news, Goldman Sachs this morning says they see the Fed perhaps as the early as the March 17 to 18 meeting, perhaps even before that. And they are suggesting and thinking of a 50 basis point reduction in rates is the call from Goldman Sachs. The European Central Bank this morning, which is also led to some of the moves in the market, saying that they are monitoring the situation and will act appropriately based on market volatility and movement. They are there to support the market. Also, over the weekend, we had the South Carolina primary. Joe Biden did what he had to do in terms of the race for himself, where he won the primary with 48% of the vote. Bernie Sanders had about 20% of the vote in second place. After that primary, Pete Buttigieg and Tom Steyer exited the presidential race. Polls are showing Bernie Sanders leading in Super Tuesday, states of California and Texas, and Joe Biden coming in second. That's at least where we are at the moment. Also in the news, recent percentages on the chances of a contested Democratic convention crossed 65%. Italy introduced a $3.6 billion stimulus package amid the coronavirus outbreak. The news flow overnight and this morning is that a second person in the U.S. has died of the coronavirus, both deaths occurring in the state of Washington. CNN reporting that Congress and the White House are close to coronavirus funding deal that could exceed $7 billion. The United States has agreed to a deal with the Taliban to withdraw troops from Afghanistan. News about the U.S. and Britain seeking a trade deal. Britain unveiled its mandate for trade talks with the United States, with Prime Minister Boris Johnson vowing to drive a hard bargain in negotiations that are set to test the special relationship between the U.S. and Great Britain. Twitter in the news. Elliott Management acquired a stake in Twitter and is pushing to remove CEO Jack Dorsey. Nike saying they're going to close their European headquarters in the Netherlands due to a case of coronavirus at that facility. American Airlines matching JetBlue, saying that they will waive change fees on all newly purchased tickets amid declining air travel demand because of the coronavirus outbreak. Specifically, American said that they would waive change fees for up to 14 days before travel for customers who purchased tickets between yesterday and March 16th. Goldman Sachs has told all its staff that all non-essential business travel should be postponed. That is adding to measures taken by other banks, especially many overseas or foreign banks. Taking a look at the Asia-Pacific region, we have seen strength over there. China, which is reporting fewer and fewer corona cases, so the second derivative or the rate of new cases going down, and the Shanghai was up 3.2%. The Hang Seng was up 0.5%, and the Nikkei was up by over 1%. We are seeing the cases in China, although climbing slowly, and fortunately that is the case that they're climbing slowly. Nevertheless, we are seeing in China increased cases. South Korea's case count is now over 4,500. And we have news that the People's Bank of China may be about to further ease as a result of the coronavirus. Also reports that the Bank of Japan has pledged to support financial markets and has offered to buy $500 billion worth of the Japanese Treasury securities. Also reports just now that Jack Welch, former chairman and CEO of General Electric, has passed away. In the news also this morning, Gilead has announced that they are going to acquire 47 for $95.50 a share in cash. That is a 64% premium to where 47 closed. Gilead had been in the news as well for their coronavirus vaccine. Moving on to the financial markets, Barron's talking about the sell-off last week. Barron's suggesting what we have already suggested this morning, but reiterate. They ran an article entitled "Diversification is Protection for Your Portfolio," and they say here's how to do it. After a decade of stocks returning an average of 13% a year and a 40-year boom in bonds, they say the once sacrosanct notion of diversification has changed, and advisors and clients need to think about diversification differently. And that is largely a result of if you are a retired person, a 60-40 split between stocks and bonds, and perhaps that 60% is in bonds, is something that retirees may no longer be able to do. If that was the case 2 or 3 months ago, it's perhaps even more the case today. And we as advisors and clients that are approaching retirement really need to think very differently about how they are going to be able to achieve the income they need in order to maintain their lifestyle. So clients with these low rates may need to be further pushed, perhaps sometimes reluctantly, or make that choice reluctantly, to consider dividend-paying stocks, especially in an environment like this. But those dividend yields relative to Treasury yields have certainly gotten very juicy. Also, the article suggests taking a look at REITs, as we have hit what can only be deemed as all-time lows in the financial markets. Barron's, talking about the crisis, talks about the fact that perhaps the event that was most similar to what we're experiencing in the coronavirus with the shutdowns is the events that happened on 9/11 when the U.S. economy was attacked and the economy ground to a halt. Federal Reserve responded by lowering interest rates. That did help the stock market reverse losses. And Barron saying whether this ends up like a 9/11 sell-off / recovery or is deeper and longer is really reliant on the facts on the ground and determining to what degree and how long this will last and what sort of impact it will have on the economy. In the short term, indices are looking oversold. Even after the bounce off of lows on Friday, the S&P 500's relative strength index, a measure of momentum, dropped to 19.1, a level that usually sees stocks rebound quickly. 93% of S&P 500 stocks are trading below their 50-day moving averages. And when that happens 3 months later, 78% of the time, the markets are higher 3 months later. There are other factors at work than the virus alone, something to keep in mind. We were at record highs prior to the virus, and perhaps we were susceptible to some weakness even without the virus. So assuming that things will automatically go back to where they were may be an incorrect assumption. Going into the coronavirus, we had the backdrop of a potentially close to inverted yield curve. Now we have an inverted yield curve. We also had the uncertainty of the Democratic candidate. Some market prognosticators suggesting that the emergence of Bernie Sanders, a self-avowed socialist, is another factor that's weighing on the financial markets. And prior to the outbreak or spread of the coronavirus, we did start seeing some other worrying signs in the financial markets. The Institute for Supply Management's manufacturing survey had slumped below 50, something that indicates a slowdown. And we started seeing some indicators that the job market was not as robust as it previously had been. Some indicators indicating that. So perhaps some other factors could be in play as well. Some other statistics here. On Thursday, the market was down 4.4%. And when the market has fallen, the S&P specifically has fallen by 3.5% or more on a single day. Study was done and then found that on average, markets were up 20% a year later, and that average number being about 80% of the time. So perhaps some light ahead, or some dawn ahead of the darkness. If you are looking for one clear opportunity right now, maybe to refinance a mortgage, or if you were considering taking on debt for other purposes, the opportunity for lower interest rates there certainly looking more and more attractive. So Barron's talks about some stocks that may be stocks to nibble on or bite on, depending on your perspective. Given the uncertainty, I'm going to talk about those. The article talks about the fact that if there's one thing that Wall Street hates more than anything else, it's uncertainty, and that's certainly what we've got going on right now. Given that the impact on the economy and profits from the coronavirus is impossible or difficult to quantify. So what do investors do? They immediately jump to the conclusion that things will be the worst as possible. It's a survival instinct. When the coronavirus was just starting to affect the markets on Monday, Warren Buffett was being interviewed by CNBC. On Monday, he said that in his mind it makes no difference in our investment thesis about the coronavirus. He said there's always going to be some news, good or bad, every day. If somebody came and told me that the global growth rate was going to be down 1% instead of 0.1%, I'd still buy stocks if I liked the price. And if I like the prices better today than I liked them last week, I'd be more inclined to buy stocks. When talking about bonds, I thought he made an interesting analogy. He compared the 10-year Treasury, and this is before rates cratered later in the week, but rates were still very low on Monday. He compared the 10-year Treasury to a stock trading for 70 times earnings that can't increase its earnings for 10 years. The effective price-earning ratio on the Treasury now is about 85, with the yield down to 1.12%. That's the calculation taking the inverse of the 10-year Treasury yield. The inverse yield on stocks, not accounting for dividends, is about 5%. And Buffett goes on to say, if somebody came to you with a stock and said, you know, this is a terrific stock, it sells for 70 times earnings, and the earnings can't go up for 10 years, you'd say, well, explain that to me again. So with that in mind, Barron's came up with some stocks to consider. On the list is Berkshire Hathaway, BRKA and BRKB, trading for just under 20 times earnings, about $87 billion in net cash, including debt. And Barron's talking about the fact that Berkshire can possibly take advantage of this location, perhaps like we're seeing now with the cash that Buffett's been sitting on. He's been criticized for it, but perhaps he will be vindicated once again. Mentioning technology stocks, speaking positively about Google, Apple, and Microsoft. Apple, I believe, was upgraded today by Oppenheimer. In the financial space, J.P. Morgan and Bank of America mentioned positively. They also mentioned Citigroup and Goldman Sachs, now both trading below book value. Bank of America yielding about 2.5%, J.P. Morgan around 3%. Bank of America trading under 10 times earnings, J.P. Morgan under 11. Obviously, the earnings may change, so there may be some effects there. For those who are brave enough today dive into the energy space, they suggested taking a look at Chevron, Texaco, and ConocoPhillips. Chevron with a yield of 5.5, ConocoPhillips with a yield of 3.5. Chevron, they talk about hitting its lowest level in many years. They also talk about ExxonMobil, which has a higher break-even, so it didn't make their list in terms of where they break even in terms of oil prices, because ExxonMobil's been spending heavily to increase their capacity, and there's certainly risk in that if oil prices don't rebound. But ExxonMobil yielding almost 7%. They say if you're looking for yield, though, to take a look at the European oil stocks, BP and Royal Dutch Shell. They have lower break-even prices in terms of being able to maintain their dividends relative to the price of oil than the U.S. peers. BP is around 31, yields of 8.05. Royal Dutch Shell at 45 is yielding 8.40. In the more conservative telecom space, they suggest taking a look at Comcast and Verizon. Comcast trading around 12.5 times earnings, Verizon 11 times earnings. Verizon dividend yield up to 4.5%. Comcast yield now at 2.30. Verizon was upgraded this morning by an analyst. Also, some individual stocks mentioned in Barron's, Viacom CBS, symbol VIAC. News that Shari Redstone, who is the non-executive chairman, after the stock was driven down by earnings a week ago, she reportedly purchased $1 million of stock, 35,000 shares at a price of about $28.50 per share, meaningfully lower than where the stock is today. Also reports that Director Barbara Byrne and a additional director and CFO, Christina Spade, also purchased stocks. Barron's conducted an interview with Ron Barron, famed growth stock investor, and I thought one quote in here was worth repeating. Nobody gets it right on the on whether the stock market is going up or down, whether you're thinking about an election or coronavirus, interest rates or trade wars. But he says that over time, if you look at markets historically, approximately every 10 years, markets approximately double. So if you're an investor for the long term, he remains optimistic. He also talks about his thesis, which is in line with Warren Buffett's thesis, which is significantly lower portfolio turnover. His portfolio turnover is anywhere between 5 to 7% on average versus some funds that have portfolio turnovers exceeding 100%. And he points out that when you look at expense ratios alone, you're not factoring in the activity of the portfolio manager. And, if you look at a fund and you're looking to save, 20 or 30 basis points, and you have a relatively inactive fund, and you compare it to a fund that's trading with its hair on fire, that has a lower expense ratio, because the fund managers are getting paid less, that overall cost to you may be significantly higher with the active fund, and you have to determine whether or not that activity is worth the cost. That's everything I've got. I'm going to turn it over to Brad. Good morning, Brad.
Good morning, Keith. Good morning, everyone. First of all, I hope everyone had a good weekend, and more important than anything, I hope everybody gets through this in good health. That's all that really matters, and the money is obviously secondary, so just have to keep that in mind. I was saying to Keith earlier, I'm not an analyst or an economist, but all I try to do when I speak is share my personal experiences, whether they're historical or current. I just try to bring a little different opinion to the table, and I try to keep it as simple as possible. Just want to give you a little background what's happened in the municipal market over time. Back in around November 2018, the muni market had a tremendous sell-off, as did the equity market. And we had suggested at that point buying some municipal bonds because they had got very cheap relative to everything else. If you had bought during that period of November 18 through April of 19, you would have been up about 15%, and you would have collected about 3% tax-free for that time period as well. At that point, the municipals got very rich versus the treasuries, and we suggested high-grade corporates and treasuries at that point as a different option. And then the treasury market rallied again, and municipals got cheap again. So there are two ways to look at municipal bonds. One is are they cheap relative to treasuries and high-grade corporates? And will you sacrifice some of that liquidity on the sale side, which I know that you're all familiar with when you try and sell 25 or 30 bonds, in order to get a better rate of return when you're actually buying? Because it's a better opportunity when you're buying when the municipal bonds are cheap relative to these other spread products. But at this particular point, like everybody else, I'm just confounded. It's the absolute rates of return are very low. If you go to try to sell a municipal bond to reallocate, you may not be happy with the bid. The municipals are trading extremely cheap to treasuries, which doesn't mean anything. So if you can get a 10-year municipal at 1.5%, it's 150% of where the 10-year treasury is, which is 1%. But do you throw that away? It's really a question. Is there a better opportunity? If you think you can do better than 3% on an after-tax basis, go get it. Absolutely. So just be careful. Take your time. Just a couple more comments. Obviously, it's been stated that if we had higher absolute rates, we'd all be pounding the table saying reallocate some of your equity money into bonds. But it's a very strange time with rates this low. We've never seen this. A couple of other things that may happen in the municipal bond market. One is if the coronavirus really spreads and becomes a major problem. It's not just a problem for corporations. It's a problem for municipalities. As Keith and I were talking about earlier, airport revenue will be affected. Some other types of revenue structures will be affected, and with less spending and tax revenue will be affected. The other thing that could happen in municipals over the next couple of weeks are, one, I don't know who's hedging municipal bonds with treasuries, but a lot of people do. And people who are hedging municipal portfolios with treasuries right now are getting demolished because the treasury market is a one-way street and is going up points at a time, and the municipal market is going up eighths to quarter points at a time. So it's a very bad trade at the moment. The other thing is that in March, you may see some municipals coming up for sale because people have to pay for April taxes. So there may be some opportunities as far as my personal experience. Last month I said the cocktail party chatter was stocks. Everybody's so proud of what they were doing. That's sign number one. About 2 weeks ago, I told you that I personally started chasing some of these tech stocks, the high flyers. That's number two telltale sign that the market has a problem. And number three, now the latest conversation is everybody's asking me what they can get for a 1, 5, and 10-year bond. And there's panic out there. And it's another telltale sign. I do like to be a little bit contrarian to what I'm hearing on the street, and but while being contrarian, you have to act cautiously, take your time, think about what you're doing, and evaluate each portfolio as well as your own personal portfolios one at a time. Anyway, I hope everyone's healthy and have a good week.
Thanks, Brad. Brad, would you be able to just run down where yields are on treasuries this morning?
Yep, absolutely. The 1 year is at about it's very flat. Everything from 1 through 5 years across the board is at 80 basis points. You can get very short treasuries, 3 to 6 months for still better than 1%. If you just want to really put some money away and then see things another day, but it's essentially 80 basis points, 1 through 5 years. 7 years is just about 1%. 10 years is fluctuating between 1.05 and 1.10, and the 30-year Treasuries at a 164, All the treasuries, fortunately, are off their low yields. It is a leading indicator as to where the market's going. It is possible that if the Fed comes in and cuts rates 50 basis points, you could have a nice sell-off, meaning higher rates on the 10 years and out, because people will go back to, will put some money back into risk assets. But that's where we're at the moment, and obviously it's all over the place. My hope is that we see some higher rates, because higher rates are the leading indicator to say how everybody's feeling, and we want to feel good. So that's it.
Thanks, Brett. Yeah, thanks, Brett. And yeah, put that in perspective when you're looking at muni yields, right? 10-year muni yields at 1% or almost 100% of treasuries. So I don't expect to see much over that.
Right, and they're probably trading around 1.25% to 1.5% right now. So you get a very big pickup in municipal yields. But that being said, the absolute rates of return are difficult to swallow, regardless what you're looking at.
Right, and also of note, we did start to see weakness in high yield and leverage loans. They were down 3 to 4% last week. I think corporates, high grade corporates, were only down about 0.5 to 0.75 of 1%, but that's significant underperformance relative to the strength we saw last week in bonds. So, you're starting to see it creep into, especially the high yield market, which is more equity like than in the treasury market. So certainly you got to be mindful. Like I said, if you're looking for retirement, you really got to think about, if you need that income, what's the best way to get it, and other opportunities, in the bond market or outside of it, to get income if you need it. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.